Hi friends, the new margin rule has come into force from today. It means if you are doing margin trading in futures and options or in equity, minimum margin for intraday in equity should be 20% of the value that you are trading. So if you are buying a share which is worth 100 rupees and you are trying to buy 100 shares, now you have to minimum pay a margin of 2000 rupees to do this trading intraday. That is maximum 5 times leverage on your capital is allowed by the SEBI or the exchange, the brokerage as per the SEBI regulations. And in futures and options, especially in futures, the margin trading has been totally taken away. So, which means in intraday, some retail traders used to trade with low capital and sell the options. Now they cannot do it. They have to pay the full option selling margin, just like it may be equal to buying one contract of future or selling one contract of futures. They have to use the similar amount of money to do option selling. But I'm seeing some interesting development because of this. I think a lot of retail traders have started trading in deep out of the money options on the put side and the call side, because just to see here, the underlying market of Nifty is around 17,220, which is 500 points away from this strike price of 17,700 expiring tomorrow. It means this option will make money only when Nifty goes above 17,700 by tomorrow before 3:30. Still, you can see here the price range of 17,700 option. From 1 rupee 20 paisa low, it went up to 5 rupees 60 paisa. In fact, I myself saw it trading at 5 rupees today. This is what is happening. So SEBI is bringing in some rule to bring down the volatility, and now investors are shifting from high price options to low price options. And see this price range for the 17,700 option from 5 paisa to 29 rupees. Up to 29 rupees it can move. So it can happen that if the operators are able to move Nifty by about 100 points here, this may suddenly become, from 3 rupees it can even go to 10 rupees because of the volatility. I am seeing the VIX, which is the volatility index, is around 15.5 now, which was just about 12.5 about a month or so back. So it looks like the SEBI regulations are doing something opposite to what SEBI was trying to do. Now let's see, the market is quoting at 17,200. I want to go and see what is the price of, let's say, 16,500 put option. Okay, let's see what's happening to that. 16,500 put option, which is 700 points away from the current market price, and there is no reason why the market will reach 16,700 in just about 16,500 in a day, because it's a crash of 700 points. This has traded in the range of 4 rupees and 6 rupees. And see the volume, 69 lakh shares have been traded. So I think retail investors are now interestingly shifting focus to low priced deep out of the money options to make a quick buck, because at rupees 5 you can buy 2000 shares for just 20,000 rupees, right? 10,000 for just 10,000 rupees you can buy nearly 2,000 shares of this. And if it goes up by even 50 paisa, so that volatility seems to be existing here. See here, the low 4.05, high is 6. So if you just try to make about 25 to 30 paisa on 2000 shares, you are making 600 to 700 rupees in a day. So that probably attracts the retail investors a lot. But it is time to be very careful in the market because the market is very high, and these kind of volatility can actually pin you down because the big operators may be feeding you with these prices, and then when the market goes down this will end up worthless. So that one has to keep in mind, because if you put 10,000 on this, and in any case tomorrow this is not going to have this kind of price, so tomorrow it may go down to maybe 50 paisa or 1 rupee at the opening itself. So one has to be quite careful. If you are doing trading on intraday basis, it is better to quickly also exit out of these deep out of the money options, especially when you are near the expiry. I hope you enjoyed this video. Thank you very much. Please like, share, and subscribe to Nifty Profits YouTube channel. Bye bye.